we all have the same demands on our life, and we don't all have the same amount of time. And that's the tricky part, is how can I free up some more time for myself and other people so that we can, spend it on the things that are most meaningful to us.
Welcome to The Path to Wealth, the show about well-being, fulfillment, and financial freedom. And I'm your host, Hennche. Hello, everybody. Welcome back to the Path to Wealth podcast. My name is Hennche. Today we have Schuyler Cadwalader, is the founder and managing partner of UpWealth Capital. He oversees investor relations, asset management, and the company's growth and vision. Before transitioning into real estate investing, Schuyler worked in architecture. He worked on award-winning projects and managed the execution from start to finish. He has a wide range of experience in design, construction, administration, project management, and building systems. He brings his full range of knowledge and experience to bear in executing UpWealth Capital's vision, helping medical professionals build passive income through multifamily real estate investments. Welcome to the show, Schuyler. Thanks for joining us today.
Hey, thanks so much for having me today. I'm really excited to be here.
Of course. And one of the things that I think is really interesting, that you have a very different angle to multifamily, because you've actually been in the ground up, kind of the vision before building the buildings as an architect. You have a very different point of view, not just one of us syndicators that goes and buys the buildings once they're in place. So how did you originally go into that field? What drew you through it? Were your parents in real estate, or what brought you there?
Well, what brought me into architecture? What brought me into real estate? Just want to make sure
Yeah, both.
Okay. Yeah. So architecture, sort of the classic. I had an art teacher when I was really young show me some books on Frank Lloyd Wright and things like that. And I just wanted to be an architect. And then the more I looked into it, the more I loved it. Always wanted to do something creative. Always just loved buildings, old historic buildings, new modern buildings. Like I just always was in love with them. And, and that was great for many years. I got to work on some great projects. But over time, I got the kind of impression that, the architect rarely gets to participate in the upside of real estate investing or development, for that matter. So it was a lot of, working for other people, working with the city, and then kind of at the end feeling like, not getting like a really big payoff. Just one day you're done and you just start a new one. And so working closely with developers over time, I sort of realized that like I was on the wrong side of the table to some extent. I think there are some firms out there that have kind of figured out how to, be more meaningfully involved with the underwriting and the equity of the projects, but I never worked for one of those firms. And so gradually I started getting the feeling that maybe I wanted to build more substantial wealth, and that working as a W-2 architect might not get me there, at least not very quickly. In addition to that, my father-in-law is a very successful real estate developer and owner. He owns well over 300 doors. He's retired now, just did a big cash out refi and went to Hawaii for a while and stayed at a really nice place. And it's, he kind of provides a window into where you can get to if you're patient and invest in real estate for a long time. And it wasn't, easy for him. It took many years and there were downturns along the way, but, he stayed diligent, and, time can be very forgiving for real estate if you can stick it out long enough. So between me seeing the developer side in my architectural practice, and also on a more personal level, seeing, how things were going for my in-laws who have a lot of real estate, I was sort of like, I think it's time for me to find a way to get my foot in the door as well into real estate investing.
I can relate to that. Sometimes we look at things and we're like, we're on the wrong side of the fence here.
Yeah. It's kind of funny because sometimes I remember early in my career, I was working on a residential project, a really nice property. And the thought kind of occurred to me, like, I will never get to design something like this for myself if I stay in this job. You know what I mean? It's sort of like, and it was sort of like, what, I don't know what I want more, to design houses like this or to live in a house like this. You know what I mean? So anyways, yeah, that's kind of what started steering me away.
I can totally relate to that from my original career, being a chef, working at some of the best restaurants in the world. And for me to be able to afford one of the meals that I used to serve to people every day, it would take me months. to save up the
Wow.
money. And it was a big chunk of money for me to go to those kind of restaurants and try to have the same experience that I'm delivering every single day to some of the wealthiest people in the world. And that's also when I was like, okay, I'm clearly doing something wrong here, because I'm just serving the meal. I don't really have the ability to enjoy it over and over again.
Yeah, it's a perfect example, actually. And I've got architect friends who just love the grind of architecture. They live for it, right? They love the process of designing buildings, and they don't really care about much else. They're not thinking about it like how we're describing. But yeah, that's like a perfect example. If you absolutely love spending time in the kitchen and you love the grind, and I know it's tough back there. I've worked in a few restaurants, but if that's your passion, then that's great. But if you kind of also just want to be on the other side of the swinging doors, and be the one enjoying the dining experience, it's you kind of have to think about that and maybe change course at least a little bit.
Yeah. So what made you focus on medical professionals, helping them? Why are you so passionate about getting them passive income?
Yeah, that really just stems from my wife, who is a physician. And, we had like this kind of crazy time during the pandemic, as we all did, but we're based out of Seattle. So we were actually in the eye of the storm when it first kind of made landfall in the United States. And that was like a really scary time for us, because my wife was actually pregnant with our first kid, and she works in critical care. And so she's in the hospital getting exposed 12 hours a day, 7 days a week, week on, week off. And at that time, we had no idea how dangerous this thing was. And so it was really scary. She was wearing like a full on suit and dealing with people who were already really sick and now also had COVID, and coming home every night, and us just being not sure what was going on. I was working from home, and the company I worked for would eventually actually declare bankruptcy after shutting down a lot of job sites and some mismanagement on that side. It's a whole nother story. And one of the things that we kind of realized, we had already been talking about real estate investing, but we realized that like we needed to diversify our income, not just our assets. I think everyone knows you should diversify your investments in the highest level of stocks, bonds, and whatever, mutual funds. And we were sort of like, yeah, now we're getting to a point like if one of us can't work anymore or doesn't want to work anymore, my wife loves her job, but there were times there during the pandemic when it was just like, this is really tough, and it'd be kind of nice to be able to step away from this, because we were very worried about our child. Thankfully, everything worked out great. That we needed to diversify our income. And again, we sort of already knew about real estate. And, things have gotten, since the pandemic, really tough in the medical profession. Hospital expenses are through the roof. There have been a lot of layoffs. It's really hard to find like nurses that will stay a long time. Basically, like in the entire medical world, things have gotten harder, much harder since COVID. COVID, I think, in some ways fundamentally broke a lot of little parts of our healthcare system, and we still haven't really figured it out. And a lot of doctors, I think, work so hard. And there's this dream of being a doctor. It's an American dream story where it's like, once you get there, it's going to be great. You're going to have the big house, the nice car. Everyone's going to be like, think you're super smart. And the reality is you get there and it's really not very romantic. It's really hard work. Not to say that, doctors don't love it. Most of them do, but you hit this sort of high point relatively early, and you're making pretty good money, but it just turns out life is actually way more expensive than you thought it would be. You start cranking out kids, there's a good chance you bought a house that was a little too big, maybe car is a little too nice. And all of a sudden you're working overtime. You see this very often in the medical profession, people picking up like per diem extra hours to work to make a little extra money. And you kind of eventually realize that like, this is actually tougher than I thought. And I'm trading a lot of time for money. And so kind of seeing that firsthand through my wife and some of her colleagues, we thought it would be a really cool mission for the company to help physicians build passive streams of income so that they don't kind of get, in that trap that I think a lot of physicians fall into, where they've got one stream of income and they need to trade increasingly more of their time for their ever-growing expenses. So, our whole philosophy is diversify your income, not just your investments. And I think doctors are, and medical professionals in general, are people who should really be thinking that way.
Yeah, I agree. My sister is a doctor, so I'm very closely exposed to everything you just described. And sometimes when she tells me that she has like 24-hour shifts, and I'm like, I don't want to be the patient on the receiving end of this. Like,
I know.
You potentially been awake for 20 hours and you're trying to take care of me.
I know it's pretty crazy actually. And it's, I don't know, it can be just a little, I think a lot of MDs, they get used to working really hard through residency and everything. But then, like I said, at a certain point, you start getting a little older, right? You have the kids. The idea of even a 12-hour shift is really exhausting, right? And so it just gets harder and harder over time.
Yeah. And I think MDs are the classical example of people that if they're smart with their money, they can totally leave the race behind, you know, and it's like they have the ability, they have the 6-figure income. And as you said, the upgrading is the trap. Like
That's
if you're upgrading
true.
too fast, if the car is too nice, as you mentioned, if the house gets a little bit too big, maybe kids come a bit early. Like if you can just be smart for a couple of years around that, I think there's a real potential. While you work your passion, you make your W-2 income optional.
I completely agree. Actually, there are very few professions that people are better teed up to achieve financial freedom, to be honest with you, because it's a great job. It's also a very recession resistant job. You know what I mean? Like that's one of the reasons I think a lot of people in the medical profession do well over the long term is they don't really get occasionally wiped out. You know what I mean? Way, so, when 2008 came, you know what I mean? Like a lot of people just lost their jobs, but most doctors I think did just fine. But the lifestyle creep is a huge thing because again, it's part of that American dream of being a doctor, right? Like, oh, once I'm a doctor, I'm going to get the BMW, might get a boat. And if you can avoid all those things and invest well, you can actually make a killing. But it's lifestyle creep is really hard for all of us, frankly.
I'll pass on an advice. A friend of mine, he's a doctor in his 70s now. He told me that the boat is a hole in the water that you throw in money.
Yeah, exactly.
Everything you said is so true. He came to the United States as an immigrant. He originally wanted to become an actor. Then he was like, okay, I won't make any money as an actor because I'm not that good.
Sure.
And he became a doctor. And then he went through everything you said. He started having nice cars, started having a nice house. He got himself a boat. Then he realized that the crazy expenses around all of that.
Oh, it's crazy.
And eventually he got a little bit smarter with his money and he made one really good real estate investment. And that kind of changed the later trajectory of his life. I think if he would have been a little bit smarter, a little bit earlier, he would have been positioned so much better.
Yeah, because time works on your behalf, right? Compounding. A lot of people don't really, truly, everyone says they understand compounding, but I don't think most people really understand how important it is. If you get started early and you're investing, tens of thousands of dollars, like 10 years earlier than, someone else, where you wind up in 20, 30 years are worlds apart. The analogy I always use is sort of like if you're a ship crossing the ocean, if you just turn 2 degrees, it may seem like a tiny adjustment, but after, 2,000 miles of open sea, you wind up on a different continent, right? So little things add up quickly. And things like boats, I mean, that's like the ultimate liability. It's the gift that keeps taking. And I think someone told me once, they said, the 2 best days of your life are the day you get a boat and the day you get rid of the boat. I thought that was pretty funny too.
It's when you sell it and you're finally free of the expenses and the liabilities with it.
Such a headache.
Yeah. So for someone in the medical field, why do you think, or when at the same time, they should get invested? Like we already touched up on it, but when is the best time for them to get started in their residency or at what stage of their career?
Yeah, that's a great question. In some sense, it's a little bit of a personal question. But I think, once you're off to the races and you're an attending and you're making your full salary, the best time to invest is usually yesterday, right? And so the sooner you can get going, the better. That said, everyone's, a lot of doctors have a lot of student debt. I personally, and different people have different opinions on this, but I'm personally of the belief that you should get rid of your student debt as quickly as possible because it's just the mental weight of it is so huge. It's taxing. It's like another tax and doctors are already taxed a lot, right? So it's like, get rid of that one as soon as you can. And then basically as soon as you responsibly can, there are a lot of doctors out there that talk about who are part of the, FIRE movement. And they talk about living like a resident, even once you're an attending. So like, don't just immediately upgrade, stay in the same apartment if you can, or just, don't feel you have to just buy a house immediately. I do also subscribe to the idea that a house is not necessarily an asset. Can be if things work out and the market appreciates, but A house takes money out of your pocket, and it takes more than you think. I'm actually about to call people later today about getting a new coat of paint on our fence in our house. And I know this is going to wind up being, it might be a 5-figure thing, in addition to paying the insurance and the mortgage and all the bills. So yeah. My feeling is basically the sooner the better, as long as you can do so responsibly.
What do you consider responsibly?
I guess I just mean like, don't throw money into an investment if you need that money for other things still, right? If you're not quite ready yet. Yeah. And that's what I mean. If you have $250,000 in student debt, and some people would say, well, if that debt is only at 3% and you can find an investment that's at, with a preferred return of 7%, mathematically, you should just put $100,000 into the investment. And, that's going to offset your student debt. And I'm like, I understand that from a mathematical standpoint, but what if that investment doesn't work out? Right? What if it winds up not performing as well as you thought? Well, now you're in student debt for even longer. You're still paying interest on a higher amount. So, or even if it could be as simple as credit card debt, like don't invest, $50,000 with my company if you've got $20,000 of credit card debt across a couple of different cards. You know what I mean? Yeah. So it's a matter of priority.
Yeah, 100%. So where do you think you're uniquely positioned to add value in the multifamily game, given that you're also part of the construction process as an architect?
Yeah, so I do think, architects know buildings well. So just from a basic acquisition point of view, we can get in there and get a look at things and probably have a slightly better idea than I guess most, at least amateur investors might. But, to be honest, there's a lot of great investors out there who aren't architects who do a really great job, and it's sort of tough when the building's already built. You know what I mean? It's like I can't change that much, but we obviously have a really good intuitive sense of design. I think we could look at a building and see potential really quickly and easily, just from whether it's the landscaping. All architects are kind of landscape architects, and all landscape architects are kind of architects. And we can kind of, see the potential in places. And I think are more likely to make better design moves when we say, do some kind of a facelift or value add than the average real estate investor who might just, find the same gray paint they use for every building and slap it up there and, not give it too much thought. That said, architects can also overthink and over design. And I think as a real estate investor, the smart thing to do is not to get too into the design aspect of it and let your numbers do the talking, right? Real estate is about math. It's about making money. It's not about, having a pet design project that, takes too much time and doesn't have a high ROI. So it's a careful balance, I think.
Yeah. But I do think it's fairly important to have the right designs, at least also when I look at real estate, whether I'm buying it or I'm looking it for my personal apartment or something, the design does attract traffic. Yeah. And, whether it's interior or the outside design of the building, it makes a difference for the appeal. Obviously, depending on the asset class we're investing in, whether it's A, B, C, or D, where at D, there's no more design left. That's for sure.
Yeah, right. Yeah, and I think it does depend on the asset class in some way. I think the heavier the lift, the heavier the reno, the heavier the value add, the more valuable architects become. You know what I mean? If it's really just a facelift, if it's, throwing down some vinyl floors and, a coat of paint and maybe just changing out a few fixtures in the kitchen, right? It doesn't take an architect to do that. If you're kind of gutting an apartment and moving anything or making it a more open floor plan, working with jurisdictions and inspectors and everything, that's when the value add proposition of an architect gets really strong. Ironically, I tend to try to avoid those properties because as an architect, I know how hairy those things can get. I've been an architect for well over a decade, and it's rare to see big projects come in on time and on budget. You know what I mean? So I have a healthy fear of ground up, but yeah.
I mean, especially in the current environment, I think anybody that executed anything on time in budget in the last 3 years gets a Medal of Honor in the space.
Yeah, totally. I don't even know how you did it. I mean, in my previous job, we had our job sites shut down during COVID, completely for a while. They eventually said, this is the kind of job that can still keep going through COVID, but it was still tough. People were getting sick, people were not showing up. And yeah, obviously the whole situation with materials got totally crazy. Cost of materials, cost of lumber and everything. So yeah, anyone who's been delivering projects on time, give me a call. I'd love to know your secrets.
But this is also a strength of you as a person, right? To keep projects on time and keep people accountable to what they're supposed to deliver, which is one of the strengths in your asset management, that you're actually making sure everything is executed as per the value add plan that you're implementing.
Yeah, that's probably actually the biggest benefit of being an architect. I mean, architects by nature are pretty detail-oriented people, and they've also had enough experience with job sites that they know what goes on job sites. I think most people don't, you know what I mean? A lot of people who get into real estate and just start on their first flip get like some really hard lessons really fast. You may hire someone who just never shows up or just absconds with your money because you paid them everything up front instead of, breaking it up over, making sure their work is getting done before you pay them.
Yeah.
And architects have a sense of, craftsmanship and quality. We can tell if someone is really doing a lousy job or doing a pretty decent job. So I think that attention to detail and just having at least some experience working with, people who work with their hands can actually go a long ways on the asset management side. That's a good point.
Yeah. And I mean, that's ultimately is a core of a successful multifamily acquisition and turnaround for your passive investors is to make sure that the value add in the units is happening on time, on budget, that the units are being released to new tenants so that the overall projections are being met so that the passive investor actually benefits from the overall project. Yeah,
it's a really good point. And I do think speed is probably an undervalued part of that. The faster you get this stuff done, the better, right? Because expenses are increasing every day, right? With inflation, that just means the cost of everything from materials to the people who install them are going up. So the more you can get done this month rather than next month or the month after, the higher the ROI is going to be and the better the IRR is going to be for your investors. I think especially in inflationary times, speed is something that maybe not enough people don't think hard enough about. Like, how can we stage this up to start banking out multiple units, back to back to back? So yeah, I think, that's a really good point.
Yeah, this is actually a really interesting one that I think in the entire last couple of years, speed has never been more relevant than, and I think we also seen that in our own portfolio when we speak to our partners, is that we're really trying to stay more on top than ever before in getting units released timely. You really don't want to sit on anything. You want to make sure that you hit your projections and
I totally agree. It's hard. It means, you're cracking the whip more often. You're on the phone more often. You've got to work harder to make things go faster, but this has been a really good time. I think real estate was really forgiving a couple of years ago. And I think now it's going to be more, okay, who are the actual really good asset managers? Who are the people who really drive value rather than buying and just sort of hoping that things get better? So asset management is really important. And I think a lot of the times that sort of gets treated like an afterthought. If you're getting into real estate and then you want to learn about it, there are a lot of people who teach you about how to acquire real estate, but that's just the beginning. There's a whole lot more to it once you actually acquire it, and there's a lot of work to be done. And it's a learning process.
And I think you've got a point. We're coming out of the decade where real estate and multifamily real estate seemed rather easy. And I think now is the time where the really good operators and underwriters will shine. And then there is a whole different segment of people who will turn quiet. And we won't hear a whole lot of them.
Yeah, then that's kind of the scary thing about private equity. In public equities, when things are going bad, we all hear about it, and we hear about all of it. From the macro picture of how the S&P is doing to how each individual company within it is doing. In private equity, it's weird because someone could blow up and they just disappear, and you just stop getting their newsletter and you forget who they even were, right? And so I guess what I mean is there can be a lot of pain in the system without a lot of signal that it's happening. You know what I mean? Unless you're, invested in that. And obviously, as an LP, you're kind of hearing all this bad news directly. And even then, it's not always easy to tell how bad things really are behind the curtain. You know what I mean? It's like, oh, we're cutting dividends for now. And it's just like, okay, we're good. Are we actually good? You don't fully know. I mean, hopefully all the reporting and everything is transparent and you do, but that is the weird thing about private real estate is it's hard to know what's really going on everywhere.
I think this is beyond real estate. It's just a private investment. Like I used to be a partner and investor in restaurant operations and services in New York. And originally, if I wouldn't force the conversation, some of those partners wouldn't update me. And I think this is also something that an LP, limited partner, or a passive investor really wants to be on top of is, who am I dealing with? Like, are they very diligent in their communication? Are they frequent in their communication? Do I get the information from them, or do I need to demand it? And I think in times like right now, okay, maybe there is no payouts. Why is there no payouts? Are they building cash reserves, or are we actually out of money already?
Right.
What's the game plan? And I think this is probably where it's a bit untangible for passive investors. How do you usually help your investors making good judgment of this?
I mean, we just communicate like crazy. I mean, I just feel like there's no such thing as over communicating with your investor. If they tell you to knock it off because you're doing it too much, then you're doing a good job, and they'll never do that. So my thing is basically just, over communicate. Tell them everything all the time. Don't wait and hope if things aren't going as planned, don't wait a long time and then all of a sudden be like, things haven't been going as planned for a while. Cause then it's like, wait, what? You don't want to, these are your partners, these are people who, you should have a lot of respect for. Oftentimes I try to tell people that there's a very good chance that your LPs are smarter than you. You know what I mean? These are people who, in some cases, many cases, are accredited investors. They've had a very successful career. The fact that they have money to invest in private real estate means they're not stupid. They're smart people. And so you want to respect that. And if you don't, they'll see it. They'll recognize it. These are some of the smartest people in the country that are your investors. And so respect that and tell them the truth. And everyone gets that investing is a bumpy road. You know what I mean? No one is looking at their 401k right now and screaming at their investment manager saying, this is your fault. Like it's tough. It's tough out there, and it's not going to go perfect. In fact, it never goes perfect. There's always bumps. As long as you communicate them and everyone feels like they can see the landscape, they can see the chessboard, they'll ride with you, to the end.
But I think at the end, there still needs to be a reward. I think right now there's many people who have like a lousy feeling about their 401ks or whatever. Like I just 2 days ago, I had a conversation with my uncle, and he told me that now fixed interest on bank deposits is getting more interesting again, because you start earning a little bit more money again. So why even bother with this mutual fund stuff where everything goes to the brokerage fees? And it was this really, for me, it was more like an interesting conversation from a mindset perspective. I'm like, here's someone that they earn significant amount of money over the length of their life, yet they consider saving the better option as long as there's some interest that accrues that's like above some 0 point something.
Yeah.
And then I was like very smart people, but they didn't go to the extent of trying to understand what compounding means. Like, okay, we're talking like single digit, small percentages, because you feel safer than even writing it out maybe in an index fund or something. And then I was like, wow, like over multiple decades, that's like such a bad choice.
Yeah, I totally agree. You see that a lot, actually. You see a lot of people wanting to just go fully risk off, and it's usually at the time when it might make the most sense to go risk on, right? Like 2 years ago, people were happy to just plow money into NASDAQ, you know what I mean? And just like, oh my gosh, like Amazon and Netflix and Microsoft, they're just going through the roof, and they always will. And now that they're down, right? people, I mean, I think Microsoft's saying whatever, but now that they're down, people are like, oh, now I want to go to my, savings account and just stick it out there for the foreseeable future. Cause at least there it doesn't go down. Right. But it's sort of like, guys, you got to zoom out. You always got to zoom out and look at that multi-decade picture.
100%.
This is very much not investing advice, by the way, but it might be the worst time to exit the stock market, right? You're actually securing your losses when you do that. You haven't, with all investments, you haven't lost or gained until you sell, right? That's the thing. It's like it can go up and down on your computer screen, but you haven't lost money until you sell in the red. And so, yeah, and to your point, that's not real compounding. You know what I mean? When you throw some money into a savings account and get that, whatever it is, low single digit interest rate. It's just not the same as owning businesses. I want to own businesses, and real estate is a business. It's just one type of business, but if it doesn't generate like kind of legitimate cash flow and appreciation, I'm not particularly interested myself. It's great to have when I'm saving up cash to buy something that's more meaningful. But I wouldn't want to just park a large chunk of my net worth into savings for the long run, unless the idea was to deploy it at some point.
I had a really funny one this week. I was going through some things and I found my first iPod ever. So it was like 2003, Whoa. 20 years old. And then I was like, okay, I paid like some 500 euros back then for the iPod or something. And then I did the math. Like, what if I had put 500 euros in Apple stock back then? And it was mind-boggling.
Painful exercise.
I was like, oh my goodness. Like this little bit of listening to music, this would have been pretty substantial by now.
It would like 10x it or something, just crazy.
Oh yeah, way beyond. It's
wow.
It's like
that was a long time ago.
Compared to today, it looked so cheap. Then they also split the stock a couple times in between.
Oh sure, yeah.
So when I was looking at it, I'm like, oh my goodness, this is like 2003 to now. But then at the same time, first of all, I wasn't able to identify that back then. Then I was thinking, okay, how can I identify something like that today? And the reality is most people can't. I can't. And the average investor statistically can't. And there's tons and tons of statistics out there that the normal person who is a passive investor will not make that pick.
Yeah, totally. 100%. There's so little chance that you're going to nail it picking individual stocks, right?
Yeah. And I think this is really where, as you said, diversification also in an asset class like multifamily plays out, because out of all the asset classes that I looked at, this is obviously nothing is guaranteed and it's not as predictable as people might want it to sound occasionally, like when they want you to put on the money. But I think from everything I've seen, multifamily for passive investors is one of the most predictable wealth building mechanisms where they can seriously compound wealth.
Yeah, I actually completely agree with you on that. It's one of the things I love about multifamily is you have to have it. Right? It doesn't go out of style. You don't get the new iPhone, which makes the iPod irrelevant, right? Where it's just like everyone needs a roof over their head forever. Whether you live in the metaverse with your VR set on your head or not, here in base one reality, you're still paying rent to someone in real life. So I that's what I love about multifamily too. And to kind of bring it full circle to that stock picking sort of thing, it's really hard to analyze a random business, right? Like Dairy Queen, as say a doctor, the people who like the Warren Buffetts, the value investors who go and, pick up assets like that, they're really combing over the balance sheets. They're really looking at the management. They're looking whether this company has like a moat, the brand. It's like a really deep dive to identify individual stocks. What's nice about multifamily is almost all of us have lived in an apartment and almost all of us get the basic value proposition, right? We pay rent. to someone, some of that rent goes to expenses, some of it stays in their pocket. And that's the business. There's, it's really not very complicated. Of course, it's much more complicated than in reality, but fundamentally, diagrammatically, that's all there is to it. And so I think just the amount of vetting that has to happen is just a lot more intuitive. Even as an LP investor, if you can find a good general partner, a good operator who has a good head on their shoulders, and they've done this a lot of times, they rinse and repeat, and this is what they do. That's like something you can kind of take to the bank. Whereas, I don't know, you start combing over just like stock ticker symbols and trying to figure out which ones are really well-run companies with really good people at the helm and really good culture. I mean, good luck. I can't do it and have no interest in trying, because I just know it would be a massive time suck. And there's still a good chance you miss, right?
Yeah, 100%. And I think there's enough statistics around it that prove that the average investor can't do, and even the professional investor can't do it.
Yeah, not really.
There's a great book, The Path by Peter Mallouk, and he has a lot of data around it that even professional investors on a long enough time horizon fail.
Yeah.
And there's very few investors, like, for example, a Ray Dalio or Warren Buffett, who decade over decade are consistently outperforming.
Yeah.
Majority of people cannot do it, even in the professional field. And I think this is one that I always remind myself of. Like, sometimes I also think like I have a little bit of money in some stocks and stuff. And then I think like, yeah, I'm smart. But the reality of it, I'm pretty sure that I will just become a perfect statistic in those.
Totally. Yeah. I mean, there's just too many of them. There are too few winners. You know what I mean? Like, that's the thing about the S&P 500. The names in that 500 bracket change all the time. Yeah. Right. So even if you go in there and pick your winners there, they might fall out of the S&P 500. Then you're really in trouble, because now they're not in mutual funds. Now no one else is buying them. Like, there's just so much to it. And even the people who've won over the long run, like, there's such like a survivor bias, you know what I mean? Like, there's going to be always someone who outperforms. Some of that is actually luck, you know what I mean? I think there's some crazy thing with Warren Buffett where like 90% of his net worth came after like the age 68 or something like that. I mean, his secret weapon is just living longer than everybody. Yeah. Don't get me wrong. He's an incredible, brilliant person and investor, but the way he got to where he is today is by making it to his 90s and just like doesn't sell a lot. He's been buying things forever, and he's been holding them forever. And yeah, that'll do it, So yeah, you got to be careful trying to emulate people like that. And if you are going to try to emulate Warren Buffett, you got to give yourself 60 years to even know if you're in the same ballpark. Because I guarantee he's taken his licks along the way too. He's taken losses. He's had bad years. And so it's a hard game.
It is. So Schuyler, let me ask you one of the questions that I always like to ask towards the end of a conversation is, what do you consider a life well lived?
Oh man, that's a good and heavy question. I think the primary thing for me is having optionality, because what makes a life well lived might change for me at any given time. And I want to have the ability to change with that, so I've got a kid now, she's almost 2, and I've got another one on the way in like 3 weeks, which is really intense. Yeah, I've got a lot to do over the next couple of weeks here before my life blows up. And so right now, being a good dad is kind of number one, making sure that I check that box. Cause if I drop that ball, then nothing else really mattered, right? Like, it doesn't matter if I'm successful in other parts of my life, if I do a really bad job with my kids. So what does that mean? It primarily means being able to give them the time and attention that they need. And so for me, a life well lived is just one where you have the ability to set your priorities and meet your obligations to family, loved ones, friends, which requires some degree of freedom, right? And this kind of goes back to, I think, the struggle that a lot of doctors have, which is just like, we all have the same demands on our life, and we don't all have the same amount of time. And that's the tricky part, is how can I free up some more time for myself and other people so that we can, spend it on the things that are most meaningful to us. So I hope that's a adequate answer.
It is. Where can people connect with you and UpWealth Capital?
Yeah, so just go to upwealthcapital.com to check out our website. You can find me really easily on LinkedIn, Instagram, or Twitter as well. Luckily, with the way my name's spelled, it's very easy to search me out of the crowd. So I won't give you the links to all of those, but I try to post on all of those platforms on a regular basis. And so come check it out. I'd also love I love talking to people and meeting people. So jump on the website, schedule a call anytime. Love to touch base.
Awesome. Thank you very much for making the time, and talk soon.
Yeah, thanks so much. Take care. Really appreciate it.
Thank you for joining us at The Path to Wealth. We hope you enjoyed today's episode. Check out our upcoming guests and be sure to share it with all your friends and family that want to take their life to the next level of wealth.